Buying into Nevada isn't the sure bet it used to be. The lights are bright, the Strip is alive, but behind the glamour, the market is slipping. Prices are trending down, listings are piling up, and confidence has drained out of the room. What used to feel like an affordable, fast-moving play is shaping up to be one of the riskiest real estate moves of 2025. Today, we're breaking down the top 10 Nevada cities where housing values are falling fast this year. These aren't mild cool-offs. These are places flashing red, where buyers are stepping back and the market is starting to unravel. If protecting capital matters, stick around. This is Investusa. No fluff, no hype, just the facts that could save you thousands. Let's jump in. Number 10, Dayton. Just east of Carson City, Dayton was sold as the next great value, quiet, roomy, and affordable. In 2025, that pitch isn't landing. New builds that once drew bidding wars now sit unfinished or empty. Values are down roughly 9% year over year, and buyer interest has thinned out. Migration from out of state has slowed to a crawl. Meanwhile, the basics haven't caught up. Dated utilities, patchy cell service, and limited high-speed internet, deal breakers for remote work. Many who expected quick appreciation are now waiting it out. Resale is uncertain, amenities lag nearby towns, and the glow has faded. The result? A slow unwind and a quieter market than anyone hoped for. Number 9, Laughlin. On the Colorado River, Laughlin offers a softer casino scene and laid-back outdoor life. During the pandemic, it quietly surged as remote workers chased low costs and investors hunted yield. Prices peaked near $280,000 in mid-2022. Now, the median sits closer to $245,000, down about 12.5%. Days on market are stretching past 80, and inventory is building as buyers thin out. Travel patterns normalizing and inflation squeezing discretionary spending have hit demand. Add higher insurance typical of riverfront proximity, and the math gets harder. Streets feel quieter, businesses see fewer patrons, and the ownership dream feels further away than it did. Number 8, Pahrump. About an hour west of Las Vegas, Pahrump long pitched rural freedom and bargain land. The pandemic wave sent prices to roughly $380,000 at the 2022 peak. In 2025, the pullback is sharp, around $325,000, down roughly 14.5%. Listings can linger more than 110 days, and inventory is up more than 35% year over year as speculators look for exits. Without strong, diverse local employment, demand was never deep, just hot. The big lot, big sky promise has cooled into a surplus of vacant homes and paused plans. The boomlet ended, and the quiet is noticeable. Number 7, Sparks. Sparks moved from Reno's shadow into center stage until momentum stalled. After peaking near $550,000 in mid-2022, the median has slipped to roughly $460,000, off about 16.4%. Homes take about twice as long to sell versus 2022, and many close only after multiple reductions. The frenzy, bidding wars, appraisal gaps, has faded. With wildfire-adjacent insurance spikes, flat rent growth, and rising vacancy, total cost of ownership is heavier than expected. Not a collapse, but the pulse is weak. What looked like a cheaper path to Reno's equity ride now feels like a detour into uncertainty. Number 6, Fernley. Fernley branded itself as Reno's affordable alternative. Fast growth, family-friendly, investor-ready. Prices topped out near $430,000 in mid-2022 and have fallen to about $370,000, down roughly 14%. Days on market push past 95, and inventory is up more than 30% year over year. Overbuilding met slowing absorption. Job growth hasn't matched the flood of new rooftops, and long-term water concerns haven't helped. Some neighborhoods lack basics or suffer from rough roads. Even 2021 buyers are struggling to break even. It's not a full-on collapse, but stability is in question. Number 5, Henderson. Long seen as the safe, upscale suburb of Las Vegas, Henderson soaked up high-earning movers and retirees, driving a mid-2022 peak near $600,000. In 2025, the median is closer to $490,000, an 18.3% slide. Listings sit for 115-plus days, and inventory has climbed north of 30% year over year. Larger mortgages feel the pain of higher rates faster, and pricing stretched too far. Quiet streets, idle pools, and empty great rooms say what the numbers do. Demand is cautious, and time on market is telling the story. Number 4, Carson City. Nevada's capital rode a quieter boom thanks to spillover from Reno Tahoe and the remote work wave, pushing the mid-2022 median near $520,000. In 2025, pricing has reset to roughly $440,000, about a 15.4% decline. Listings now linger 90-plus days, and inventory is up more than 28% year over year. With fewer high-earning newcomers and local wages stretched, homes sit longer. Neighborhoods that felt busy a few years ago are noticeably calmer. Momentum has eased, and affordability is the choke point. Number 3, North Las Vegas. North Las Vegas was a magnet for families and first-time buyers who wanted space and relative value compared with the center of the valley. Prices crested around $460,000 in mid-2022. Now the median sits near $380,000, down roughly 17.4%. Time to sell has stretched beyond 120 days, and inventory is up more than 40% year over year. Affordability is tight for working households, mortgage rates are heavy, and aggressive building created a mismatch. New neighborhoods feel quieter, with empty driveways and idle playgrounds underscoring the shift. Number 2, Reno. Reno rebranded from gaming town to tech outpost, pulling in firms and residents fleeing California costs. Prices peaked near $620,000 in mid-2022. Today, the median is closer to $500,000, off about 19.4%. Listings can sit 130-plus days, and inventory is up more than 45% year over year. A broader tech slowdown and severe affordability constraints have cooled demand. The energy that defined its reinvention has thinned. More for sale signs, fewer arrivals, and a slower rhythm on the streets. Number 1, Las Vegas. Las Vegas is the epicenter. After a pandemic-era surge, fueled by remote workers, California inbound, and heavy speculation, the median hit roughly $480,000 in mid-2022. In 2025, it's around $370,000, down about 22.9%. Days on market exceed 140 on average, and supply has more than doubled year over year. Out-of-state buyers have receded, investors are liquidating, and builders with excess inventory are discounting into a softer market, pushing comps lower. Entire tracts sit under-occupied. The boomtown feel has quieted and the reset is unmistakable. Final thoughts. Across Nevada, Laughlin to Vegas, the pattern is the same. Steep price declines, swelling supply, and a clear step back from buyers. For peak buyers, equity is under pressure or negative, and selling is tough in a slow market. The drivers are familiar: stretched valuations, higher borrowing costs, fading migration tailwinds, investor exits, and, locally, overbuilding in select areas. This isn't a mild correction. It's a fast, broad repricing. The risk: a downturn that could bite even harder than past cycles if rate pressure, investor selling, and environmental headwinds persist. Stay alert and be deliberate. In markets like these, knowing where not to buy can be just as valuable as finding a deal.